we're going to go over it. I'm Chris Kerrigan, by the way, and I'm going to have Dan Shanahan, who actually was a general agent with Mass Mutual for a number of years and now runs Modern Capital, a big broker dealer here throughout the country. So he's going to help chime in and make this a little bit more interesting, as well as Angela McIlvain, who's been my business partner and in the industry for over 20 years, knows her stuff inside and out. So I thought, rather than just hear me talk for an hour and 40 minutes, we got three of us. So maybe we'll walk away and learn something here. So we're going to talk about, next page, please, Melinda. So it's funny, we represent here at GP Agency about 50 carriers, and each company has, 10 to 20 products each. So we've got 500 to 700 different policies that we can choose from when offering it to our through our brokers to our clients. So picking the right product has always been an interesting challenge. This is my 30th year in the business. I started with disability insurance, so I know DI inside and out, but every day I'm learning about which product fits what scenario the best. So now that we have a couple of experts here as well, I want them to help chime in, and we're going to have a couple of case studies at the end and go over that as well. So, when I first joined this firm, we didn't sell much whole life insurance. I came from Mass Mutual, spent about 20 years with them, and Mass has always been known as one of the top whole life carriers, or carriers for all product lines. And today, how many carriers are left selling whole life insurance that are, what do you think?
Maybe five.
Maybe five. You got Northwestern Mutual, you got New York Life, you got Guardian, you got Ohio National, you got Penn Mutual just pulled out, Emeritus. There's a Lafayette. There's a few others that aren't in the top class.
Less than 10.
Less than 10, probably. There may be more, but the household names that you're familiar with. So we're going to go over whole life, which is the right fit. UL, which is basically term for life, and we've got IUL, which is the newest player, and VUL, which I'm glad, because I'm not security licensed. I'm surprised that they have this in our discussion, but Dan is, and we wholesale it. So Dan's going to be able to talk about that a little bit. Rating agencies, which is really interesting. When the crash hit in 07, 08, these rating agencies had some of these insurance carriers at AAA ratings, and then next thing you know, the next day they're out of business. So I think they took it in the chops right there, because they weren't doing their job, and they were sort of just getting paid to give higher ratings. So, and today we're having and Dan's going to talk about that. He just had a great article the other day about, which companies are coming in, and like Ohio National was bought. Dan, if you want to touch on that.
Sure. I think the question on this was, when you're looking at, for your agenda, when you're looking at, what products, what you're going to choose, you also got to look at the company. And, we're having a systemic shift in the insurance industry right now, where the traditional old guard is shrinking, and there's a new player in town, and it's mostly private equity, where they're coming in and saying, hey, we can do this better than these old stodgy insurance companies. And they're trying this. And so you've got to look at this from two different lenses. One, you got to go, hey, these folks have been around for 100 years. They know how to do reserves. They know how to, make sure they get claims paid. They know how to, navigate the insurance industry. Then you've got this new world of private equity, VC money, where they're coming and going, we can do it cheaper. We can do it faster. We can do it more technology. We can do it better. And they're giving this a shot. And so that's going to be a decision that you make. And, because they don't have the track record of playing out claims. And, a lot of people really don't understand reserves. A lot of insurance companies didn't understand reserves when they created variable annuities and things like that, and they got crushed. A lot of them are still doing it. I've got still a product from Principal back in the day that pays me 4.5%. They call me every year asking me to get them to buy it out, and every year I say, your deal's not even close to being quality, ready to go for that. I'm not taking the buyout on that. And so there's a lot of moving parts right now going on in the insurance industry to see who's going to survive. And you're seeing the Principals of the world really divest themselves from the individual life insurance business. You're seeing the pop-up of, hey, we can get you insurance in 22 seconds. And some of them are actually delivering on that, getting up near 50% delivery on that. That's incredible, because we were with Mass Mutual a long time. They were trying this with a thing called Haven, and they couldn't move the needle past 10% of getting policies issued and through. But some of these places now are upwards of 50%. And so it's just a different animal because they're using total algorithmic underwriting, using AI information. You know, Chris and I actually applied, I don't know, can't remember if Angela did, but we actually applied to a company where we knew the head underwriter, and I got coverage for $1 million of 10-year term in less than 4 minutes. And so that's a different animal. Now, you know, they're underwritten by a large insurance company, so you feel a little bit more comfortable with that. But there's some of these guys that you know, are coming in that have no insurance experience, and they're trying to upset the apple cart on that, and as well you should. I mean, there's a whole bunch of that going on in the world, so why not in the insurance industry? And so you probably hear a new product or new carrier that can get you life insurance. You know, Ethos, you know, Haven,
Ladder.
Bestow, Ladder.
There was a new one today.
Yeah.
It was called, I don't know, like Butterfly or something. I was like, what in
Many
the?
of them.
Yeah, it's so many. So every day it's changing.
Yep.
So they're going, literally, I applied for that as well. I got $1 million of coverage I timed it in 3.5 minutes.
Mhm.
So you plug in your name, your social security number, they're already hitting the, you know, LexisNexis, your MVR, your script check, credit, and in 3.5 minutes, I was approved.
And you've got a deck page. A
They
minute
email
later,
policy.
your policy, the whole thing's ready to go. It's crazy.
So for those of you that are working with SBA lenders, they need that to collateralize their loans. We have a great solution for you. You know, that it's usually not a permanent sale. So this is usually a term to satisfy that. But so we'll get into all those things and what's the right fit. And then we got 1035 exchanges. So Angela pretty much knows everything about those. So I'm glad she's here with us. And then, like I said, the case examples. We'll if we have time, we'll go through each of those. So we'll try to get this done. We've got a couple of questions in between, right, Melinda?
We have opportunity for them to ask questions.
That as well as they've got
But I'm
it.
monitoring the chats as well. And
Okay. So, but at 11:30,
So 11:30.
make sure you're near your computer,
Yeah, because there will be a polling question.
and then one at 12:30. So I'm tipping my
Right.
hand here. So you
Right.
got to be by your computer. Those two at those points to make sure you answer those questions, or they won't give you credit. And trust me, we can't override that. We
Right.
tried in the
Yes.
past.
Yeah,
Somebody's computer blew out. They don't care because
because they have to.
it's tough enough to police this as is.
Yeah, it's the online activity that they track.
Yeah. So permanent life insurance, long-term needs, taxation, you know, with Uncle Joe in office right now, everything's on the table, I believe. And, you know, who knows what's going to happen? Can you imagine what a disaster it would be if they start taxing cash value within life insurance policies? But it is on the table. It's always on the table. It was like number 8. I saw a thing what they're looking to go after. And that is always on the table. You know how much money that the government's saying, hey, we should be getting ours there. Only super wealthy people can buy permanent insurance. So we've got to go after them.
$500 billion.
Is that what it is?
Taxation they could get.
$500 billion. So, you know, can you imagine unraveling that and what that would happen to our industry? Everybody would just buy term insurance,
Yeah.
right? So we've got to keep our lobbyists in there fighting for this. So, you know, I used to be president of the local NAFA here in Raleigh, North Carolina. Dan was as well. And I think Angela, we all took our turns. And that was our one thing, our pact, that we were throwing money into that just to make sure they keep fighting for us. So if you ever get the opportunity and you see that, please throw them a few dollars, and, you know, that helps everybody. So then the tax deferred growth, as we know in permanent insurance, you're not getting taxed. But like I said, it may be on the table. Generally, income tax-free death benefit. Angela's phone's talking to her. And then surrender or lapse could potentially create taxable income. So you got to make sure, you know, if it's going to MEC or not, and those type of things. So if you're not sure, ask an expert. We have a staff here of 25 that are here to help you. So if you're not sure, if we don't know the answer, we'll obviously go to a carrier and one of their tax department and ask for their advice. So we got a number, and Mass Mutual has a pretty robust group. What are they, about 8 folks up there that you can rotate through?
Yep.
And you got an 800 number. You can always, one thing they don't allow is you to have the client on the phone with them.
The only way is their attorney will talk to the client if the advisor's on the phone with them.
Oh,
if their advisor's on the phone with them.
Okay.
Yeah.
So picking the right product. Product type, it's a tough one. We get, you know, inquiries every day. What product should we put for this person? And is it term, is it permanent? And permanent is a pretty loose term. Permanent is basically universal life, IUL, whole life, variable life. So that's confusing for the newer folks that come to our industry. They're saying, a permanent insurance is, they don't know for sure which one it is. So it's a pretty all-inclusive term that covers all of them. So what riders do you want to put on there? And riders can be from child coverage, future insurance options, which I wish the life insurance industry did a better job of that. Because like with disability insurance, you can buy, let's say, a $5,000 a month policy, but have the ability to buy 10,000 more of coverage without any medical underwriting. Life insurance has always done a very poor job of saying smaller amounts. You can buy $1 million policy, but typically they'll only allow for another $100,000 cap that you can buy without any insurability. Do you know of any carriers that offer any more than that?
And typically you're going to see those buy-up options for life insurance on carriers that traditionally have been career carriers, like some of the mutual companies like Mass Mutual, Mutual of Omaha, Penn Mutual. Those products are usually the ones that you can buy the rider for guaranteed insurability, and then it's going to be limited to a certain amount on those. We typically don't see it with other carriers that are not old traditional carriers to offer that rider.
The other one is the most common rider, I think, is the Waiver Premium,
Right.
where if you became disabled, it covers your premiums. And typically it's only a 5-year benefit period. Most people don't know that.
Yeah, the other popular riders today are obviously accelerated benefit riders, which are hybrids of long-term care. Of course, long-term care riders, they're extremely popular. They're probably the two riders that we quote most often, second to Waiver Premium. And that is highly sold because of the shrinking long-term care traditional marketplace. We don't have many options left for customers to buy traditional long-term care, and people have definitely bought into the idea of having a hybrid long-term care solution that if they don't use it, obviously they haven't lost their premiums. It gets paid as a death benefit or even gives their family some leverage for some additional amounts of insurance. So that's extremely popular right now. We have a very robust portfolio of accelerated death benefit riders that are standard, and then they have the enhanced ones that go even further to talk about critical illness, chronic illness, also activities of daily living. And then of course we do have the long-term care riders that meet the definition of long-term care, that have the same stipulations as traditional long-term care, where the illness would be in nature of 90 days or longer. You have to meet 2 out of 6 activities of daily living or a cognitive impairment. So those products are extremely popular right now on all permanent plans, because we can offer those riders on whole life, universal life, index universal life, as well as variable universal life. And then on the index universal life and the variable life products, we also have riders like overloan protection. Most of those products are used for cash accumulation sales, whether it be supplemental retirement planning or just cash accumulation sales for strictly down the road. Those overloan protections are pretty popular. Also premium financing, a lot of people utilize that instrument, and overloan protection is pretty important, because you don't want to be in a situation where a person is taking out policy loans and then they end up lapsing their insurance policy and they suddenly have what's called boot or phantom income, which would be taxable to the insured on their gains. So that overloan protection is pretty important when you're looking at a strategy where a customer's planning on doing match distributions from their cash values of their permanent life insurance policy. So that's something to be looking for as well on those products. And then there's also products to put additional insured riders on different contracts that we have. And then also if you're buying survivorship universal life or survivorship whole life or survivorship IUL, which there's only a few of those in the marketplace, they also have estate protection riders. That means that if the estate tax were repealed in a certain period of time after you bought the contract, it would actually pay an additional benefit to help cover that gap. There's also riders on there as well to do what's called a policy split, which means that you bought a survivorship policy today and unfortunately, you and your spouse parted ways at some point in time in the contract, then you can buy a rider that will allow the policy to split in half and turn into 2 individual policies. This can be very important, especially for some individuals if they are on second marriages and they need the death benefit protection. It will protect you in the future. You need to keep that insurance and you need to split the policy. In the event one of you became uninsurable, that would be a very important rider, or if you became divorced for whatever reason.
How do you sell that rider to? When you're sitting down with a husband and wife, right?
The life insurance prenup.
60% of marriages end up in divorce, so
Yeah.
let's add this rider.
If you're dealing with a couple that may be a business owner and he's on his 3rd marriage, then that might be a good rider to add to the
I
policy.
got a few friends like that. So the waiver premium, the one thing I want to touch about that is if you've ever priced it, if those of you that put waiver on all your policies, if you ever priced an individual disability plan versus the waiver premium rider, it's so much less expensive to buy a standalone disability plan. So I never recommend the waiver unless they say, no, I don't want another disability plan. I'll show them what it will cost. So definitely look at that. And as Angela mentioned, the long-term care riders, the one downside of that is what we had 100 carriers writing long-term care 10 years ago, at least 100. Now there's, how many we have? A handful?
Probably 5.
5 or 6. And the one downside to, if you're a business owner and you like that tax write-off with the long-term care, when you add the rider to the life insurance policy, you can only write off that portion of the long-term care rider. So it's usually about less than 7%, 6%.
Yeah, it depends. If you're buying a single premium product that you're paying single premium for whole life and hybrid, then obviously that number is a lot larger. But if you're contributing 100,000 single premium on a hybrid life long-term care policy, one, those have features that will allow you to get your premium back with many of the carriers, but only a portion of it, probably about, sometimes it's 40%, sometimes it's 60%, depending on the age of the applicant, that would actually be attributed to long-term care. So you just have to be careful when you're selling those to make sure that if you're doing it if a C corporation is actually paying the premiums, that you are full disclosure that the whole premium is not tax deductible.
All right, well, we spent 23 minutes on the first page. So
Well, I just want to mention,
Yeah.
Demetrius had a comment.
Sure.
He just wanted to mention that New York Life offers a PPO rider that will allow a person to buy additional coverage without proof of insurability. It's usually applied to juvenile policies. Additional purchase windows start at age 21 and runs through 42.
Mhm.
Age 42.
Yeah. See, good quality carriers like New York Life, Mass Mutual, you got a lot of, about the top 5 or 6 will usually offer that on their whole life products as well.
Right.
Let's go to the next, please.
Yep. There we go.
All right, the $1 million question is, how much death benefit do I need? I had a guy when I first got in the business, he said, you got to buy your weight in gold. I'm like, all right. There's also what underwriting will allow. So if you're in your 20s, they'll allow what's your multiple times your earnings? 40, is it?
Well, it depends. Like you can, generally speaking, there's several ways that insurance companies will qualify you. One would be, of course, a multiple times your income, and that amount is much greater when you're younger. Usually on younger ages, you're going to see anywhere from 20 to 40 times your income for personal insurance as a death benefit that will be allowed. The older you get, obviously, the less amount. Most people don't know that if you're over age 65, that amount drops dramatically as far as the amount times income that you can get for personal insurance. It even drops even further if you're over 70. And we recently had a client that bought term insurance 10 years ago, and now they're 70 and they want to buy more insurance. And at age 70, they don't financially qualify for the same amount they did 10 years ago on their previous term. And the reason is the factor drops at age 70 to 5 times your income. So that's something to be careful. That's a pitfall that you want to be careful in making sure that you've planned out accordingly for that death benefit protection and the needs of the client. We commonly use and promote a concept to determine how much death benefit a person needs. Obviously, in doing needs analysis, there's a DIME approach that the industry uses, which is like debt, income, monthly expenses, and education. So those are things that you can use. And we have all kinds of information that we can provide you. Anyone that's interested in one needs analysis, calculators to calculate how much personal death benefit that you need, as well as worksheets and strategies that will give you a lot of really helpful information in doing those needs analysis and determining what the appropriate amount of insurance is.
And we just passed the anniversary of 9/11. And I don't know how many of you would know this, but when the 3,000 folks in the towers passed away, the government gave one CPA in New York City $2 or $3 billion to pay these families out. And so the only way that they thought they could pay these folks out is a concept called human life value. And human life value is basically, let's say I'm a 30-year-old physician and I'm making $250,000 and my expected COLA on that is 4%. Let's just say, these are just hypothetical numbers. So and then my projected retirement date's 65. So they're going to take that 35 years and they're going to use that COLA factor, and that's how they're going to pay me out. And that's how they paid out the janitor, and that's how they paid out the Cantor Fitzgerald, financial advisor that was making $4 million. That's how they paid the families. And so the insurance companies came up with that concept of human life value. And so that's another way. So if you ever get into a jam where you go, my client says I need 3, but the insurance company's only saying we need 2, this is where you come back to us and we can get you that 3 usually, because we have different methodologies that we could show that underwriter that we've used with them in the past to get them the most death benefit. And so that's one way to do it.
And then with COVID, anyone over 70, they
Right.
put brakes on that. So they're starting to loosen up again. Would you agree with that, Angela?
Absolutely.
Yeah. So, so those that were on, I think we had 2,000 cases that were shelved because of it, right? Some big number.
There's a lot of cases.
There's a lot of cases that we have
during
postponed.
COVID.
Yeah. All right. So what is the willingness and ability to pay? Each product is obviously so different in the cost value. Term insurance is obviously the big gorilla in the room, and it's the least expensive way to go. You're just renting the coverage. And I believe 1% to 2% of term ever pays out in the death claim. So, you wonder why the insurance carriers have the biggest buildings in each city.
Right.
Their actuaries are pretty good. They know what they're talking
If
about.
I was going to sell you something that had a 98 or 99% chance of not working, would you buy it? If it was a car, or if it was a watch or whatever, that's what term insurance is. Nothing wrong with it because it's great for temporary needs, but again, it almost never pays out.
But then again, I was reading an article today in Alabama. This is the first year ever more people died in Alabama than were born.
Yeah.
Because of COVID. 64,000 people died, 58,000 were born.
Yeah.
That's not a good trend.
No.
So I'm sure our rates are going to be impacted down the road a little bit on this. So,
Well, I saw an article this morning. They're looking at possibly surcharges on health insurance if you're not vaccinated.
I saw that, yeah.
If they're going to do that in health insurance, they're going to come and try that on life insurance.
Heck yeah.
So I think that's a possibility. But it's very strange. This is a weird time because actually we're up in life insurance sales as an industry. We're up 21% in the second quarter alone. And then this other stat said 42% of Americans are driven to buying more life insurance right now because of COVID.
Mhm.
And so I think that's something you got to use out in the marketplace, in your social media, in the way you discuss things with people. Hey, this is real. You need to get this. We don't know what the impact's going to be. But at the same time, these underwriters are still issuing this stuff. And if you're vaccinated, then go ahead and get it. Let's go. And so, just from a sales standpoint, you need to educate your clients on what's going on out there.
Has anybody put this on a question
I'm
for
sorry?
an application?
I don't know.
About
Has anybody
vaccination.
asked about vaccination on
No.
Not yet.
No, the only,
It's a
the
good
only
question.
Don't you
It's
think they
coming.
will?
Probably.
The only time we're asked about vaccination currently is if we have older age applicants that have medical impairments. Like if you have an applicant that's, over the age of 70 and they have a medical impairment like diabetes and they're rated, then some carriers during this COVID environment, if they're rated over a certain table, will postpone them until they say the ease of COVID, whenever that is going to be. But if they've been vaccinated, they have been lifting some of those restrictions in the older ages. We're not seeing it in any of the younger ages, but the older ages are the ones that they're asking about. It's not required, but it allows some of the older ages that have medical, multiple comorbidities to make them be able to get an offer where they previously would have been postponed.
Yeah,
Gotcha.
but it was coming on the health insurance.
Yeah, it's coming.
Yeah.
What other products do they have? DI annuities, LTC, and do they have any living objectives, education, supplemental retirement? I've got 5 daughters, so I know I got to plan for 40 semesters of college. And my youngest graduates in 2038. So yeah, I'm an old guy to have all that ahead of me. So I have a few products in this line. So with that being said, we got 11:30 right now. Melinda,
Yeah.
would you,
I'm gonna.
everybody get ready to answer a
Yeah.
question?
Yeah.
I don't think it's a tough.
It's not a tough one, and, let's see, do you see it?
No.
I don't know, I don't see it. Let's see, maybe I need to stop share. Launch, okay, launch, that's fine.
There you go.
All right.
What is the question?
Okay, what type of life insurance do you sell the most of?
Good question.
Did good.
Did you get to pick these, Melinda?
Yeah.
Did they give you a list of things?
No, I just, I
Like,
can come up with any.
Oh, okay. That's.
So I was curious, and I thought that would be a good poll question.
Mhm.
Okay, good people, you got a few seconds here. Get your answer in.
We know the answer.
And it looks like the winner is term at 55%, whole at 24%, universal at 27%, and final expense at 12%. All right, I think everybody has, let's see, you still have one more second. Okay, we're gonna end this poll.
Everybody answer?
So,
Can they go back if they missed it?
No.
No?
unfortunately not.
All right.
Bad time for a bathroom break.
Right.
You want a break?
No.
No,
Oh,
I'm saying it would have been a bad
We'll
time.
have
Yeah.
we'll have a break at noon
Could
for
watch
about
But
ESPN
10
or Matlock.
They got a
10
warning.
minutes or
Matt
so.
Lodge.
If folks wanna grab a sandwich or run to the bathroom, so at noon you can.
So,
have a break.
Quantitative versus qualitative, focusing on example guarantees, death benefit, account cash value. How much do you want to buy or do you want the quality? So you do have to give up on one or the other according to what your pocketbook can afford. So,
And that's why you buy term insurance, you're looking at, that is a quantity play, high death benefit, lower premiums. You're only for a window of time, obviously the longer you have a policy, the more risk the insurance company is assuming because you could die during that period of time.
and the one thing, we talked about the bestows and the ethos and all those. A lot of those don't allow you to convert it over to a permanent plan. Right. So you get what you pay for sure. Like we say, Mass Mutual quality carriers like New York Life, Guardian, all those, those term, and they are limiting how long you can convert to. So it used to be every 20-year term you could convert for 20 years. Right. Or
Now you
30.
have-
Now you got like some
You
of them
have
are
to buy
8 years, either, which I don't like because who remembers 8 years, 8 years
Well,
later?
Yeah, because they don't always tell you.
They don't ever tell you.
Well, and the thing, a lot of companies have come out.
But
Yeah, a lot of companies have come out with what's called a continuation extension rider, conversion extension rider, which means that if you don't want the traditional, what they have recently started offering on their least expensive product, which would be usually either 5 or 7 or 8 years. If you want to go the full term, you can buy that with many carriers on the term insurance for an additional premium. Prudential is still a really good carrier as far as allowing you to be able to have the full term to convert, but that is something on the less expensive terms. You want to be sure to make you have checked that conversion privilege to see how long it's convertible. And then if the customer wants a convertible for the entire term, then it might be worth the investment to put that additional. It's actually a separate product that will have the name of the term product CER behind it. When you see it on the quoting engines, that would be the one that's got the full conversion. And most products are convertible when you have that for the full term to age 65. And if you are preferred plus, there's a few that will let you convert to 70. But traditionally, it's going to be to 65.
One of our more successful agents here in town, he will not sell a term longer than 10 years. I said, don't you ever sell a 20 or 30? And he said, because they're gonna outlive me. So I want to be able to convert it. So selfishly, that's all he does. He goes, my plan is to always convert these things. So in 10-year terms, the max I'll do it and show him. Thought it was interesting.
Yeah.
Yeah. Next page, please.
All right.
So quantitative premium, as Angela mentioned, term is the best bang for the buck. Everybody, starter families, everybody, buy sell agreements, pretty much is always term. But then the illustrative cash value accumulation. This is the most important feature, I think, in all these plans. This is the one the government, like we said, can't get the little greedy hands on. It's growing tax deferred, and then you can pull out the money tax preferred. So you take out your basis first, and then you take loans after that. So it gets around never paying Uncle Sam any growth on that. And that's what they don't like.
Yeah.
Well, and you want to make sure that you've done a needs analysis with the client to make sure that what they're applying for is going to be within their budget with their finances. We try to make sure we get it right the first time, offer the best product for the client's actual needs, to make sure it's financially suitable so that there's no buyer's remorse. And also too, so you as an agent can keep your, lapse ratios to a minimum, because obviously that's important to insurance companies in selling products, as far as lapse ratios and things like that. And also for agents, most of the carriers within the last few years, if you lapse a policy, not all, but the majority of them, if you lapse a policy within the first year to 18 months, some 24 months, the agent could be financially devastated as far as there could be a commission chargeback. Most carriers now, especially if you've lapsed a policy in the first 12 months, there's definitely going to be a commission chargeback. And then some of them go up to 18 or 24 months. So be sure to check that and make sure that what you're selling to your client is suitable and that they can afford it. Obviously, there's always life events that happen that are out of your control, but doing that legwork up front is going to ensure that you've made a suitable sale to your client that is going to allow them to keep the policy and so that they can afford it.
And then you got premium financing too. We've got a couple of hybrids now. Kaizen is one of them that Emeritus offers, where a wealthier client, I think if you're earning over 6 figures, you're eligible to participate in these programs. And it's basically paying a percentage of the premiums for up to 10 years. And the bank pays the rest. And then in year 15, it pulls the cash back out of it to pay back the loan. And then you've got a paid up policy going forward. It's a pretty good concept. Unfortunately, the commission, once again, it's horrible, but in the right situations, if somebody needs a lot of coverage and only wants to put out of pocket for the next 5 or 10 years, they got this thing pretty down. It's pretty cool to see if anybody out there is interested in seeing that. And Angela's working on a large premium finance case last night. She was on the phone till 9 o'clock with California. And what's the situation on that one?
So we have a gentleman that's a business owner, and he has a lot of discretionary cash. He's in the real estate business in California, which is actually booming right now. Unfortunately, you have a lot of people that are trading houses, swapping because money is cheap and people are moving. So it's still a decent market there. Commercial market there is actually better than the residential. So he's making lots of money and has a successful long-term firm, and he wants to do some supplemental retirement planning. And since money is so cheap right now, he wants to utilize instruments of arbitrage between what the insurance company's policy can actually make versus the low cost of financing the premium. So he's interested in that, and we're helping him explore what would be the best option for him. And obviously that is a permanent insurance sale. We are helping him compare the difference between IUL premium financing versus whole life. Whole life in a market that's volatile like today would probably be my winner as far as using premium financing, because you're actually going to put your customer right now in the best position because of market volatility. We know that, first of all, lending interest rates are not going to stay this low forever. So that's something to consider. Also, too, in the equities market, insurance companies are having to use hedging in IUL products, and they're having to buy options. And right now, because interest rates are low, and this sounds kind of crazy, those options are high. So they're kind of expensive. And so in order for insurance companies for IUL products to get higher caps and spreads on their products, they've got to buy different options that are more expensive. So what that does is you can get an illustration that will project very high, but the internal cost on those insurance contracts are much higher. So on the years that your S&P index or whatever option you chose within that index product is not performing, those insurance premiums are still have to be the cost of insurance and the expenses still have to be paid, and you're paying a premium in order to have those higher ceilings for projections on those products. So we caution people in this market environment, because of the market volatility, low interest rates, with interest rates expecting to rise on the lending costs, to really consider maybe being a little bit less aggressive at this time period and considering doing whole life with a company like Mass Mutual. Mass Mutual is a 170-year-old mutual company. They paid dividends for 153 of those years. And the reason that they didn't pay for the entire 170 is because the state of Massachusetts wouldn't allow them to do so. So they have a really long track record of being very consistent. Whole life has guarantees that IULs do not have. Whole life also doesn't have surrender charges like Index Universal Life. So in this market condition that we're in, we are recommending to most people try to look to the more conservative option, because we've never been in an environment with the economy where it was so politicized, meaning that it used to be just about numbers and figures and projections, but now, world events and world markets, as well as everything being politicized, actually having an effect on our market. And you can't hedge against that, and you can't predict that. So if you would stick with a more conservative model until that's settled out, to the markets have settled out, I think that your client will be much happier and have better results. But we do premium financing for both of those types of products. And traditionally you'll see premiums being borrowed for 5 to 10 years. And then at some point having the insurance contract pay back the loans. During that period of time, the customer's paying interest only on those loans. And if the insurance cash value is not adequate enough to meet what the bank loan is owed, then the customer will have to come up with some additional collateral, like either property, pledged securities, or letters of credit, to be able to show the bank that their loan is covered. So those are some of the things to consider in doing that. It is a really good instrument if you don't mind taking on a little bit of risk and using arbitrage between money. It can work actually really well in a solution. So if you have anyone that might be interested in that has that need for business or estate planning, give us a call. We'll be happy to walk you through what's entailed into that. Typically, you're going to want to see someone that does premium financing that has an excess of at least $10 million net worth, that for them to be really an appropriate candidate, unless they are in a situation where just recently they now have a really high income stream. So just let us know how we can help you with those.
Excellent. Next page, please.
I just changed the challenge with quantitative selling.
Yeah, everybody's like, what's the hot product? Every broker, and we're out there, as soon as a carrier comes out with a new product, we're like, what's the newest thing? An IUL is probably the hottest product out there. It does have its place. I personally own whole life. I own IUL, I own UL, and I own term. But it's a place for each thing. So what's the hot product today? Like I was saying, that Kaizen, or, premium financing for middle America, and, don't chase after it. Most of them have a zero floor. So you say, well, I can't lose money if the market drops. Well, that's not true, because you still have those internal charges. So you could lose money, and there's a cap on it. Typically it's 10, and it can be changed monthly. So insurance carriers don't like to lose. I mean, they don't usually lose, right?
That's right. They're not going to.
They're not going to in most cases. And as Dan mentioned earlier, these VC companies coming in and poking their head around. I think American National, Anico, just was purchased by one of those. Isn't that correct?
Yeah, venture capital
company. Yeah. And then Ohio National purchased by another. So I'm dying to see what the dividend rate is going to look like when they, what is it, the end of the month?
Yep.
Or no, October?
November 1.
November 1. Usually Northwestern Mutual leads away. They don't care, because it's their captive force. And then every other carrier falls in behind them and says this. So I think we're going to see a huge shift in that.
Mm-hmm.
I mean, like minus half a point.
Well, the pressure on the mutual insurance companies is huge, and in so much that a lot of, if you understand how the inner workings of these things work, in this interest rate environment, there's no way that the sales and the expenses that they're making can cover the dividends today. It's not possible. And so they're having to go to other internal channels within the company to borrow money. And they don't use the word borrow, but they're borrowing money from other lines of business within the mutual insurance company to pay this dividend right now.
Prop it up.
There's only so much pressure that can continue to have. And now, so November 1, when the interest rates reset, the dividend rate resets, I think you're going to see some significant changes there. Some companies have already done it. But then the other side is we're talking about these VC companies and these private equity companies. They have a much more shorter view than the long-term companies, the mutual companies. And so they're going to be saying maybe 2, 3, 5, 10 years from now, where's our money on this? And you're going, well, this is a longer play. And so there's a real push-pull in the industry right now. And I think you're going to have to make some decisions as an advisor or talk to other people about this. Where do you feel more comfortable with? Because there's pressure on both sides. There's not an easy answer on this. And so we've heard of one big mutual insurance company whose CEO told the life insurance side, we're not funding your whole life dividend anymore. We're not doing it. There's too much pressure on it. And so you're seeing that's a big deal, because you're going to see that thing go maybe 5.5%, 6% to 4.8 all of a sudden. And that's a huge jump in dividend, huge. And then again, you're going to see some VC guy go, I want my 50 million back. And where do I get that? Well, you just can't do it that fast. It just doesn't work that way, man. And so understanding how these insurance companies works is really important. And it's something for you to continue to educate yourself on, because there's articles about this every day and it's only changing. Again, maybe 8, 9 VC companies have come in recently and are in the life insurance business. That's pretty wild.
It truly is wild, wild west.
And long-term low interest rates are a great friend to the consumer when they're borrowing money, but it is terrible, absolutely terrible for life insurance companies, because they have and the reason it's terrible is because obviously life insurance is one of the safest instruments that you can purchase today, because they're the only institution that's required to reserve all their money. Unlike banks are not required to reserve all their money, and obviously life insurance companies are heavily viewed and under a microscope with the rating agencies. Banks are rated totally different. So your money is extremely safe, and that's what makes the life insurance industry such a good industry. But long-term low interest rate really, really hurts them tremendously. As a matter of fact, we have very limited carriers that actually want to have single premiums on any type of permanent life insurance product, because most of them do not want your money. They do not want your client's money right now. They want the money paid to them over time, with the idea that hopefully interest rates will rise, and that future money that they're collecting is going to be at a higher rate, so the insurance company can actually make a bigger return.
It's like dollar cost average.
Right, exactly. We only have a handful of companies that own universal life and index universal life that will actually take a single premium, and that could be, that could change tomorrow, because, the pressures are real as far as, the effects of low interest rates to insurance companies.
Yep. All right.
Are there any questions out there?
Not at the moment.
I like this one. Which car are you going to buy? And you're going to ask a few questions. Are they all the same? A, B, and C? Why are you going to pay 40 grand for a car or pay 20 grand for the same thing? You're going to want to know what year it was, what model, what bells and whistles are on it. And similar as the life insurance, you're buying term as car A, permanent is car C, but you got a lot more that can happen there, a lot of cash value growth. So things change awfully quick. You just got to educate your clients. It's tough enough to sell life insurance. We're selling an intangible as is. And then never mind this economy and everything that else is going on. It's not easy. You can't even go see people face to face. You can't do seminars anymore. You can't do a lot of things. So I'm glad to hear, Dan, you said the industry's up.
Yep.
20%, 21%.
21% Q2.
I'm surprised at that.
Yeah. And then the ironic part was in 2020 it was up.
It was.
It was up over 2019. So I think people figured out a way. And again, you got to figure this out, guys. You got to figure out a way to sell in this environment. And obviously you got to get really good at the Zoom aspect of it. You got to get really good at your social media and get really tight on that. we had a guy who did nothing but seminars, and he was doing the old school seminars where, you bring 10 families into Ruth's Chris, you pay for the steak dinner and the whole deal. Well, he just decided to scrap that and start sending the steak dinner to their house with a bottle of wine. And so they're doing it right there on the television with 10 families. And they get their steak and their, bottle of Silver Oak or whatever, and he's still killing it, just slaughtering it. And so you just got to figure out a way to get creative, go to, use your, strategic alliances in town. And we always have had good luck working with employee benefit firms, property and casualty firms, CPA firms. They still have that need too. And so we can help you with those things. But part of the deal is just getting engaged. And this is one of the things I say every day. The average financial advisor, and I use the financial advisor very loose, the average advisor in this country is 59 years old right now. And so we've had, between COVID, technology, compliance, we've had a lot of people just chuck this industry, and we're not doing a great job of rehiring people in this industry. Northwestern and New York Life are about the only ones that are still hiring kids. And so we're not regenerating people into this industry. So the great opportunity for you is there's less people doing this every day. There's more people that we could have opportunities with. You just got to get really good at getting out there and getting your message out there. And so I think that's just one thing that some people have really taken advantage of, and others have kind of put their hands in the pocket and said, I don't know what the hell to do. And so that's an opportunity for you, and we can help you with that stuff as well.
Yeah, and getting up to speed on technology is huge, because of the environment changing. If you don't embrace technology, this industry will definitely leave you behind. So, some people are doing it, some people are retiring because they don't want to do it. But if you really, it's really a time to reset your business, reinvest in yourself, reinvest in your business. And if any of these technology platforms you are not really great in using or in doing presentations, please let us know. We will be happy to help you learn how to do some of those things. Also, to be able to do Zoom presentations and things like that. Like, the call I did last night, we had people all over the country. 2 were in California, 2 were in North Carolina, 1 in Massachusetts. We were all on the same line, being able to show a presentation, show illustrations, and go through, and it worked nicely. So, some people are intimidated by technology and being able to do that. Please don't be afraid of it. We have people that can help you, and we're happy to help you be able to embrace some of those to keep you going in the business.
And we got funnel marketing that we've actually, when we bought this agency, how many years ago? What are we,
2007.
2007, so 14 years ago.
Mm-hmm.
We were an insurance IMO. That's all we were. Now we're a technology company that offers product. I mean, we've totally switched. I'm a dinosaur. I'm 52, soon to be 53. This was not my friend.
Not a dinosaur.
She's not. But I am, and I'm like, I'm fighting it. And I got my 4-year-old helping me with my iPhone. So so look at this class that we're putting on. I mean, we're in 5 different states with 40 people. It's pretty cool that we can do this today. And the carriers are signing off on it, just like our applications. 2 years ago, you couldn't do an electronic signature on the DocuSigns and all this other stuff. It was all wet signatures. So I don't think it's ever going to leave us.
Yeah.
It's only going to get more progressive, would be my guess. So
And I just want to ask if there are any questions. I do, a chat just popped up here. Let's see. Angela knows who she is. Okay.
Yeah.
Since I'm re-entering the business full time, I want to be your model business. When can we set up a time to begin?
Oh, perfect.
That's from Timothy Healy.
Immediately.
Yeah, just give us a call after we're done, Tim. We appreciate it.
Got your back.
Whole life insurance. Everybody's like, oh, that's where, if you really break it down, a lot of consumers think that's where we make all our money. They think that that's the highest paid commission product there is. And that's, in reality, it's not true. It's the best product for the client, in my opinion. I own a 10-pay product. I own an L65 product. So you mean mine is I paid for 10 years, or I paid till I'm age 65, and the other product that I have. So no other products that are guaranteed that you only have to pay for those 10 years, 65. You can't stuff more cash in them, even if you wanted to. So I love whole life for certain things, and retirement planning is without a doubt, it's one of my favorite pieces here. So you got guaranteed death benefit, guaranteed premium to level, cash values are guaranteed, then you have a non-guaranteed column. If you're not used to looking at those ledgers, it can get pretty intimidating. And that's when I ask you to call Angela and let her break it down for dummies, because it's amazing how she can shed light on it and make it look really simple, especially for the consumer. Because if you're not comfortable looking at it, just like a lot of people don't sell disability insurance because they don't want to look stupid. I mean, there's a lot of moving parts in those, non-can guarantee renewal, conditionally renewal, what, all these things. It's overwhelming. So agents don't sell it anymore. Very few. So just like with whole life insurance, there's all these additional riders. And now with Zoom, you don't have to be the expert, Tim. You can have your client set up a Zoom call and we'll be on the other line with you to help you walk through the ledger. So you don't have to get up to speed on everything right away, because it really is intimidating.
We do quite a bit of that every week. Like I actually have one this afternoon with an agent, his client, and we're going to be on Zoom. So don't let that intimidate you. If you don't have access to Zoom and you'd like to do that, you just give us a call. We have access. We can set it all up for you. We have access to conference lines as well. We can set that up for you. We're happy to do presentations with you for your clients to walk through these things.
The only downside, I think, on whole life insurance is you got to pay. You have a down year or 2 years. How many people lost their occupations during COVID and they have a 10 pay and they're like, well, I can't pay those premiums. What do? There's partial surrenders there. So that policy has a lot of flexibility where the IULs don't. They have surrender charges and it could be as long as 18 years. Those things, you got to kick those things around forever. So know what you're selling to your client. Would you own it yourself? And if you would, then just sort of like, once again, I'm going to go back to disability insurance. When I first got in the business, this guy, Bill Widener, he's been here forever. He's like, let me see your policy. And I didn't own one personally. And I was a wholesaler for Paul Revere disability insurance. And I didn't own one person. I went out and bought one and I have 4 or 5 since. But you've got to own it yourself before you can sell it. I truly believe that.
Oh,
yeah. So even Melinda's agreeing because she's a newest agent, right?
Yes,
When did you
that's
pass your?
About 6 months ago.
6 months ago. All right. And we've got another young guy here, Eric, and I think he's been here 6 months. And we're on fire hose with feeding this kid information. And I think the light just finally went on last week about how this works. So it does take a lot, and there's a lot of products out there, which is the right fit for each individual. Next page, please. Oh, there we go.
You see the.
So Dan had mentioned the dividends. We're coming out in November. You can go to the next one. We've sort of did all that. And if anybody out there wants this presentation, we can certainly email it to you. So just make sure that you send it to Melinda, and we'll send this on out. Dividends on participating policies. That's why those big whole life carriers, mutual companies are important. They might have a 4% guarantee, but the dividends are actually paying 5.5%. In the 80s and 90s, we've got a chart that shows all the dividends that were paid. Do you remember? It was like, in the 80s, it was like 14, 15%.
That's right.
It's crazy. And now it's 4 to 5, right?
We got some 6s.
We got a 6 in
We
there?
got a 6.
Can we get a 6?
That would be nice.
Master a 6.
Yeah.
Yeah.
But they're internal charges, not to bust on them or to give them too much, but they're a more expensive carrier too. So when you have a higher dividend, it does offset some of that.
Very true.
And keep in mind too, the one, every product has its place. It's just making sure you position it correctly. And whole life has some wonderful things called a guaranteed cash value that you won't see in some of the other products. If you look at a lot of the index universal lives or either the guaranteed universal life products, if you look on the guaranteed side of the ledger, you're not going to see a lot of cash value on that side because those products, the guaranteed UL is focused on just basically term for life, the lowest cost, paying the cost of insurance for the lifetime of the product. So you're not going to see much cash value on the guaranteed side of the ledger. IUL, they're using, hedging and things like that. And you are participating with the insurance company in the market to figure out if you can make more than the traditional return. So you're not going to see a lot of guarantees on the ledger side. But the one thing about whole life is whole life has that contractual premium. It has to be paid, whether it's paid by you or your cash values or your dividends. But that's also the beautiful thing about whole life is that it creates guaranteed cash value. So on a whole life policy, you're always going to see guarantees on the guaranteed side. You're going to see cash values in there, which makes it a wonderful product for people that are looking for that, especially in the earlier years. You know, in the first 10 years of a whole life policy, by the end of year 10, if you're selling a good product, you should be able to give the customer all their money back and actually maybe a little more. You won't traditionally see that with IUL or GUL products in the first 10 years. One, because most IUL products have anywhere from a 10 to a 19-year surrender schedule, depending on the carrier and the product that you're selling. And GUL is never designed to have cash anyway, so you're not going to see any cash on that. It's just basically a low-cost play for life. So that's something to keep in mind, especially if you have someone and you're selling to them and they're interested in cash value. You may want to consider looking at, you know, the different products that might be appropriate. But if you know you need to return the money a little bit quicker than a longer term play, you have someone that's 55 versus 45, then whole life might be a good fit for them. They're going to pay a little bit more for it, obviously, but you're actually going to be able to return the client's money to them much faster. So that should be a consideration.
Yeah, we just had a client that was turning 54, business owner, and he's planning on selling his company in the next year. So this broker asked me, he goes, Chris, what would you do with this? I said, well, this is easy. Sell him a 10-pay with a long-term care rider because he didn't have long-term care or his spouse. So he's like, why would you do that? I said, well, because when you sell the company, the new owner, say your obligation is still pay these premiums.
Right, as part of the buyout.
Part of the buyout.
Yeah.
And it's not a huge number compared to what they're buying. And he's like, that's the best idea ever. And every once in a while, I think Angela taught me that one, so I stole it from her.
Well, and to the dividends, you know, and participating policies, I think that's really a big point. Because before 15 years ago, every policy in the permanent space was a participating policy.
Yeah.
There are now non-participating policies, and that's grown as these mutual companies demutualized and took the payout because they got their stock. And so they took that money and then they sucked that money right out of the dividends and brought these things down to non-participating policies. And we can name 10 or 15 of them right now. And so the big issue right now is we're seeing cost of goods go up, skyrocketing 7, 8, 9%. Inflationary rates, as far as mortgages, loans, are not participating in that yet. When do they? Because right now, and I've said this before, there's so much pressure on these insurance companies to pay out on these dividends. There's so much pressure, and they don't have the money right now. So they're borrowing it from somewhere else. And if they're going to continue to be at a low interest rate for the cost of money, not the cost of goods, the cost of money, then we're going to continue to see insurance companies drop out of participating life policies into non-participating life policies. Something we got to watch now. And
The other fact is
Yeah.
the other inevitable thing that will happen eventually is some will completely drop out of it and others will just have, you know, the cost of insurance is going to go up.
Yeah. Which traditionally or historically, the cost of insurance right now is as cheap as it's ever been.
Yeah.
It's been easier to get. And I saw another article today that people still think life insurance is hard to get. It's not. In the history of the world, it's never been easier to get life insurance.
And it's
Ever.
never been cheaper.
Ever. And it's never been cheaper. You got to sell that story. If I was you today, I'd go out and put that on your LinkedIn. I'd put that message out. What are you thinking today? Facebook? What are you thinking today? I'm thinking today that the history of the world, life insurance has never been cheaper or easier to get. Give me a call. That's an easy one for you. Just a stupid message, but it's better than some of these messages you get from people saying, what are you doing for Groundhog Day?
Yeah.
That's so dumb.
Dumbest.
Somebody's playing golf.
Yeah, you know, did you have a great 4th of July? Nobody gives a damn. Put a message out there they can get behind. I've got life insurance that's cheaper and easier to get than in the history of the United States. Call me. That's an easier message to put out there.
You know, it's true. About 35, 40 years ago, you know, a lot of people, younger professionals coming out of college would go into insurance sales because they could sell their peers, anybody, term insurance, and it would be like $2,000 for a couple $100,000 plan. Now they sell their peers $1 million policies, $200 a year. They can't make a living doing it.
Right.
And nobody's going to listen to the young buck coming into the business.
That's right.
So that's why the industry is, the average age is 59. And I don't see it getting any better because you can't live off selling these small
That
policies.
average keeps-
You can't just keep going. I remember when we bought the agency, you know, and we were a couple of years prior to that. I think the average age agent was in their 70s. And we're like, uh-oh,
Okay.
we've got to go out there and get some youth. Nothing against 70-year-olds because they'll make one sale and outperform 20 20-something-year-olds
Right.
because their peers have the money now. So it's, but you got to have a healthy balance. So we got a timeout here,
We're gonna take a 10-minute break.
10-minute break. And we're going to finish, since we only took a 10-minute, we'll finish at 12:50.
Yes.
All right.
Well, we'll be back here at 12:15. You won't miss any polling questions.
Okay, 12:15.
Yeah, let's see, 12:15.
We need some like old music.
Run to the restroom, grab a sandwich. There you go, stretch your legs.
That's exactly right.
Right.
So how are you doing, Miss Beth?
What's going on, girlfriend?
Trying to keep it together.
Yeah. You have a lot going on as always.
Yes, kind of busy.
And it just came to me, you and I were gonna get together finally about something. I can't remember what now, but when I saw you at the church, I guess
Yeah.
it catch the fire. I don't know.
It's been kind of busy. Everybody's been busy. It's a crazy time we live in, isn't it?
Yes, it is. Totally. Yeah. Mhm.
Step out.
switching the screens, so there's somebody still here. All right. Especially fun.
Yeah, I got a funny story before we get going. My daughter and all her friends went to Dirk Bentley in the concert Friday night, and they're two twins that
Are we on mute?
No, this is fine. And this is a question for everybody out there. So my my daughter's friend is in the porta john, and her phone slips and lands in the porta john. So you can imagine at a concert how lovely that is.
Oh, God.
And she had to dive in there and get it.
That's so bad.
Yeah.
Go get a tetanus shot.
Oh, that makes me laugh every time I think about this poor girl Whit.
And, you know, we'll wait for Angela, I think she'll be here in a couple minutes.
Yeah.
But we have a question. What is the best type of life policy and company to purchase for a young grandchild?
It's a good question. Juvenile policy. They give you standard ratings. That's the one thing about juvie policies. They don't require bloody urine. So I would do a 20 pay. You know, matters how long the grandparent plans on paying, or, you know, what kind of health they're in. Because, you know, grandpa or grandma passes away, who's picking up the premiums in the meantime? So you want to try to keep it somewhat affordable, but lock in their insurability And now, like I was saying, I got 5 daughters and I wrote them, each of them have a juvie policy whole life. And at age 18, you can go through underwriting and you can upgrade your health class from standard to preferred or any of those classes. So that's a good question. But we read a
Probably
lot
whole
of
life.
Oh my gosh. Well, that wasn't
That's
good.
okay, I got it, Chris, go ahead.
That freaked me out. I thought the world was landing on me.
Well, yeah.
Long falling. All right,
Um,
it's just our sign.
Well, apparently I knocked it down. But
Yeah,
We're live.
we're
Yeah,
live.
I was almost dead.
Yeah, I think she survived.
Yeah. So my plan is with my juvenile policy on each of my daughters, and they don't know this, is when they go to get married, hopefully, one day, I'm gonna give them the policy with all the cash value in it and say, here's your wedding. And here's the funds inside of it, and they should have about $30,000 to $40,000 each, assuming they get married around 30. If they get married sooner, it's not gonna have as much cash value. But so I'm gonna hand it to them and say, it's your policy now. If you want to use the cash for the wedding, or you can buy a house with it, you can let it keep growing. But if you've ever seen a juvie policy that goes about 80 years, how much cash builds in those things? It's like gazillions. It's if there's such a number, it's tens of millions. Anyway, so we do a lot of juvie policies, and yeah, just give us a shot. Like I said, if you want to be with a quality carrier, you know, since I'll give mass props on this one, but there are a number of companies, New York Life and a bunch of others that we work with. So let's see. So in about 10 minutes, we're going to give you another question.
Yeah, 12:30, I'll come do another.
We'll do another one. So make sure you're on that one to get credit for this. And like I said, we can finish up.
Yeah, we got
In
quite
about-
a few to go through, I don't know if we have.
Yeah, we're probably not going to make it all the way through this, but we, you know, this seems to have worked pretty good. And the feedback I've gotten is they like this panel approach, because you don't want to just hear me. And these two are experts as well. So on a lot of different things that not that strong on. So I like this setup.
I think we probably can move on from traditional whole life. though.
Well, I want to hit that one last
Okay.
thing, that direct recognition. Dan, I'm going to let you explain that one if you like to.
Sure. So direct versus non-direct recognition, we've got major companies who go head to head on this. And, you know, there's the Northwesterns, the New York Lifes, the Guardians, the Mass Mutuals who have different opinions on this. All right. And so direct recognition is I take a loan, it affects the cash value. Okay. So basically they're taking that money out of my loan and it's showing as a loan. Non-direct recognition is saying I'm taking that money and it's not showing the cash, it's not showing against the loan. And so it's crediting that loan amount in your cash value. So it's two different thought processes. I'm not saying either one's right or wrong, but you've got to look at that and take a closer look. And those companies that are writing big whole life, you know, major whole life contracts, they have two different opinions on direct and non-direct. You know, from my end of it, I'd prefer that if I take a loan, my cash value is still running as if that loan never came out. It's like a phantom loan. But you know, there's pros and cons to both. And one will also change the expense ratios within that. And that's something that you never get to see, is what are those underlying expenses for all these insurance companies. You're never going to know that. And so that's only going to sort out afterwards, which is why, you know, illustrations are great, but they're not as they're good for about 25 seconds. Because as soon as that happens, something changes. You know, whether the interest rates change, the market changes, you know, taxes change, crediting rates change, blah, 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 blah. Illustrations are great, but you know, they're not really worth the paper they're printed on 5 minutes later. So, you know, those are some things you really got to look on is on these policy loans is which side of the fence you're on. And both sides have great arguments for both of it. I've just been on a non-direct recognition side for a long time.
And if you're ever in competition and you're in a non-direct, you're bringing that to the table and somebody else is bringing the direct recognition, you want to show an illustration 15, 20 years
With a loan.
With a loan when you start pulling out money from the policies. You will look so much better than a direct recognition policy.
Just explain that in just layman terms for people that may not be as familiar with that.
So I got $1,000 in the bank. and I decide to take 100, and I've been getting 5% on my money. Because I took that 100, there's only 900 left in the account. The bank in a direct recognition setting is going to give me 5% on my 900. I go to a non-direct recognition organization and I take 100 out of my 1,000. They're going to give me 5% on my 1,000. Different animal. Now, again, there may be higher underlying expenses under the non-direct recognition concept than there is the direct. So I can't tell where that washes out, but that's how it works out. Is they're treating as if I didn't take the money out in a non-direct recognition standpoint.
And I'll hear, well, I don't need the money out of it. Well,
You don't only need the money when you need it.
Question.
Yeah.
Do you decide direct or non-direct participation at the time of purchase?
it's a carrier.
Some carriers you can make that option, others you cannot.
And most carriers, it's either or. I mean, like a Mass
One or the
Mutual
other.
is all non-direct. They
Right.
don't have the
Right.
It's company specific.
company
Right.
specific.
There
Yeah.
are some companies
Company
though
and
that
product.
allows you to choose though.
Oh, I didn't.
Yeah, Guardian did.
Okay, good to know. All right.
And the other thing about direct and non-direct, you want to make sure you're reading a contract is sometimes, especially with a few of the mutual companies, they can have products that have, direct recognition in the form that if you take out a policy loan, the loan amount, if you have a loan on the policy, it actually can reduce your dividend. So
Right.
you want to make sure that you're
Right.
checking those things to ask those type of questions.
And it's easy to get these two confused because I always thought
Oh, yeah.
non-direct should be the direct, the vice versa. So
Right.
I always gonna catch myself when somebody asks me, what's the difference? It just seems like they should have the opposites,
I
but
agree.
it's not the
Yeah,
case.
and non-direct, you can always remember that if you take money out on non-direct recognition, that it does not directly affect the policy as far as the crediting rate.
Those not directly, yeah.
Right.
Non-direct.
All right.
You gotta be careful with partial surrenders, because if you're doing partial surrender, depending on the type of contract, partial surrenders are subject to taxation, and partial surrenders can also be subject to surrender charges.
Traditional whole life guarantees,
Yeah, I think we've pretty much beaten this
Okay.
one to death.
Yeah.
So we'll
dividends.
are not guaranteed, like we said, 1st of November. I think we're gonna see a lot of changes in a lot of movement there. So this is gonna be pretty interesting how your policies that you sold 5-10 years ago that have been holding pretty steady are gonna see a big decline. So you're gonna have to do an in-force ledger and let your clients know, hey, maybe you're not gonna have as much cash as you thought.
And
And
then,
we'll do a comparison, once all the mutual companies have come out with their dividend rates and publish those, we will send out a comparison for you to be able to compare to see where, everyone ended up this particular year on the dividends.
and there is also pay attention to as the dividends change, and right now, no one's gonna raise their dividend. There won't be anybody in the industry that raises their dividend. That's not gonna happen. So they're gonna lower their dividend. They're also lowering that guaranteed floor on new policies. Some you're seeing from 4 to 3.5
Yeah.
already. So 4 to 3.5, you'll see that. You'll see the dividend come down to 5, 4.45, 4.75, whatever. You just got to figure out if you can sell that. And that's one of those things that's going to be up to you.
Because we're gonna talk about IULs, and IULs, tied to the market. The market's going like gangbusters. It's tough to sell against that.
Right.
Well, and here's the other thing, you gotta keep in mind too, even if a whole life company, lowers their guarantees to 3 or 3.5, Index Universal Life, and VUL, they lowered theirs to either 0 or to 1%. So they're still, the mutual company's whole life is gonna still have a higher minimum contractual guarantee in the contract than those products. Obviously, the Index Universal Life and the Variable Universal Life, you are, the client is assuming a little bit more risk and even interest rate risk, and they are willing to do that in hopes of being able to have a higher ceiling, higher earnings potential.
And a lot of people say, now we're going to universal life. How do you explain universal life? And I've always, term for life is what I call it. So
Well, and the thing about universal life was originally designed for a person to overpay for the cost of insurance in the earlier years of their contract to create a cash reserve that would help pay the cost of insurance in the older years when the cost of insurance has accelerated. And if you did it correctly and it earned enough interest, when you got to be 80, the life insurance carrier was not writing to you saying, we need more money to keep this policy in force because the cash values were sufficient to pay those higher costs of insurance and expenses in the older ages. And the key on, traditional universal life is to make sure that there is either internally on the guaranteed universal life, they show zero cash value, but they make that assumption based on an internal cash value that the person is paid timely, they paid the full amount of the premium and haven't been late. And so they've calculated right down to the penny on guaranteed universal life what it takes to keep those guarantees in force for a lifetime. So it's important that the customer pays timely, doesn't skip premiums, and pays the full amount. And those will work fine as long as the customer does that. If the customer does not pay a GUL product on time, or they skip a payment, or don't pay the full amount, that would dramatically impact the shadow account the insurance companies use to keep those guarantees in force. So the customer would need to be willing to make up those missed premiums or late payments with the interest that's involved to catch that up in order to keep those guarantees sufficient. On the traditional universal, current assumption universal life and index universal life, it works a little bit differently as far as you are trying to create a cash reserve that will continue to support the policy when the cost of insurance starts to accelerate in the older ages. If you're not meeting with the current premium or cash values aren't sufficient to meet those cost of insurance charges and expense charges, then the insurance company is going to send your client a letter, and the client will definitely have to pay more premiums. And at that point in time, you're really looking at, if you have minimally funded a universal life or an index universal life, and the insurance company is writing you and asking you to increase your premium amount in order to keep the policy in force, then you really have turned that customer's policy into a one-year term, and it's going to get very expensive pretty quickly. I took a phone call yesterday, an 80-year-old, his premium last year was $36,000. This year it's going to $46,000. And they're trying to figure out what they're going to do and how this happened. And so that can get pretty
I'll keep
interesting.
you up at night.
We know how it
Pretty interesting. Large policy, families that definitely, want to keep the policy in force. So, just make sure if you're showing any kind of assumption product, that you put your client in the best position, maybe to offer some. It might be a good idea that if they definitely need the insurance to last forever, maybe do a hybrid sale where you split it and do some of it in index universal life and then some of it either in guaranteed universal life or whole life, to make sure the policy, they've got some insurance that lasts as long as the client does.
Probably.
Taking a loan though. Are they not taking a loan?
Or they could have missed the payment.
Yeah.
Right.
I mean, there's a lot of things that
They
can happen.
hadn't
It gets
taken
ugly.
they hadn't taken a loan. It's just that the person paid under target premium when they purchased the policy way back when, because they thought the market was going to do so well. But there's a lot of factors involved. The market is only one part of IUL. You also have to look at the internal cost of the contracts themselves, and if insurance companies had to raise the mortality in it based on their own experience. So those are all things, plus the sequence of returns. The sequence of returns on IUL and VUL are extremely important, and they're missed many, many times as far as the performance of the contract. So it's not only just projecting some realistic assumptions for the universal life contract, it's also the sequence of return and how that might affect policy. So you just want to make sure you do a lot of due diligence and properly fund those contracts to make sure your client doesn't get in trouble.
Traditional universal life from 1978 till about 2010 was the most volatile life insurance contract we had in the industry by far, not even close. Because these contracts were sold at minimum premiums at very high interest rates. Jimmy Carter era, they're selling these policies for 12, 14, 16%, saying, hey, this looks pretty good. But the premiums only met 10%. So when it dropped to 5%, all of a sudden, that guy's out of the industry. No doubt about it, because he was a hack for selling it, and it was almost if it was guaranteed. And then left to guys like me to call those clients and say, hey, I'm new with Acme Life Insurance Company, and I need an extra $200 a month from you and your fixed income. That's awful. So that was really, really bad. The universal life business got really hit because of internal expenses, and then selling them as high interest rate vehicles when they really should have been a 5% type of vehicle. And so that was an issue there. And so universal life kind of got a stain there. And that's the generation that created IUL, which was, okay, let's get more into the actual market and be more market correlated versus floating interest rates that relate to the Fed. different animals, right? And so I can correlate the market now, and then if I can put a floor on that, then I can guarantee that this thing will be alive forever. What I can't guarantee again is whether those expenses are going to change. And what will happen with the IUL marketplace in the expense structure, because that's what happened to UL. And that's, in some way, shape, or form, that's what's happening to whole life right now in a low interest rate environment. They can't keep up. So they've got to draw money from somewhere else to make that happen. VUL, the other side, you're talking pure market. Now they've added a bunch of guarantees that in the last 5-10 years that they hadn't had before. So a lot of people got their tails kicked in the 2008 breakdown in the marketplace. That was a big problem then. So, but now it's got some backstop. So this is all you doing due diligence. This is all where, if you don't want to do this, we will do this with you, because there's a lot of moving parts here, and your career is on the line when you tell somebody in a UL contract in 1982, yeah, this is guaranteed, man, at 12%. No, it's not. You're going to have to be out of the industry because you're going to get sued, and you're going to get sued really, really well. So this is the stuff that you really got to look at.
And you want to make sure that you're doing some proper stress testing. Most of our illustrations will allow for us to be able to run the guaranteed minimum, an alternate, and then what the insurance company is currently projecting or paying. So you want to make sure to always ask for that alternate in the middle. So that actually shows you how the policy would perform. Like, for example, if you're illustrating an index universal life or a VUL and you're illustrating 6.32, then you want to be able to also have an alternate category of 4.32 just to show the customer, hey, this is what happens to the policy at this funding level if we just have a 2% drop in the interest rates or performance. You want to make sure that you've been, given full disclosure and you're doing the right thing to put your customer in the best position.
We need a question, right,
We got a
Melinda?
question here. Haven't IUL products been shown to lower the client's cap rate over time and the cost of insurance increases?
I think that depends by generation of product, but because the time that we've been sitting in here, there's been probably 2 or 3 new IUL contracts issued in the industry. This stuff just comes out daily, and so I'm sure for sure that the answer is yes to that. There's 75, 80, 100 alliterations of this different type of policy out there.
Yeah, and the reason being too, insurance companies are, when they get slapped of doing something like how the traditional universal life got in trouble when what Dan was speaking to in the 80s when the interest rates were 14%, and then the whole industry went through model regulation and things that you had to do in order for it to be one compliant illustration, as well as there were some rules, and that's continued to evolve. There's been more regulation in the last several years where you can only illustrate a certain rate for IULs on an illustration. So they're continuing to police that, or continually. But the one thing that you always have to remember is if you are selling something at minimum premium, you're putting your client at much more risk, and you need to disclose that to them, because the situation is the market is only one piece of it. The market is, either if you're in a variable, you've got the entire market with funds to choose from, or if you're in index universal life, then you've got some S&P index or S&P index, an index with the S&P. Those are usually the choices that you normally see insurance companies giving for those options. That's only one piece of it. The other piece of it is the expenses and the mortality cost from the insurance company. And then there's a third piece, which would be a lot of these index universal life products have what's called multipliers or bonus interest. And what they do is they say, if you have your product with us, some of them 5 years, 10 years, 15 years, they illustrate that they're giving you a bonus for longevity, or they're illustrating where if the market performs at a certain amount, they will give you a benefit multiplier. And all of that, one, is very confusing methodology to the client to actually figure out how much money they've made. But also, two, those are things that can change in future policy years. So, for example, an insurance company will publish in their policy a minimum cap rate for their index, and they will also publish what a maximum spread can be. So it can fluctuate between those things. And in market conditions, when you're selling an illustration, those illustrations are all based on whatever the cap rate is at the time that you sell the policy. So even though the market could be performing, if for some reason the insurance company's hedging costs more or options cost more, they could actually lower your cap even though the market could be performing at a much higher rate. So those are things to be mindful of. And that's why you want to make sure that you have some cushion in the funding of those policies.
All right, we gotta ask a
We
question
gotta
right now,
poll.
right?
We gotta do a poll.
We gotta do a poll, so everybody,
Everybody ready for the poll question?
Poll.
I forgot to show the results of the last one. So there we go. Okay. Let's see, where's the next one? It's supposed to be here. Oh. All right, 221 insurance barometer study.
Let me see it.
Still haven't shared it.
Oh, I'm sorry. Sorry about that. Okay. The study says, or asks, what percentage of women say they are very knowledgeable about life insurance? What percentage do you believe is correct?
well, in this
Well, we
room.
need to be 100. Don't women know everything?
That's why I was laughing. I don't see the answer on here.
What do you think?
Way to go, Angela.
I would put-
Really?
I'm just guessing. I'm optimistic.
Okay, good answer.
Thank you.
And wrapping up the types of life insurance policies, you're gonna have to add a slide next year because these companies are talking about coming out with an indexed whole life. And so that's next.
Wow.
I don't know how the hell they're gonna do that,
I
but
don't
they're
either.
talking
I
about
did
it.
hear that
I
one
heard
too.
about it
Yes.
last night.
Yeah,
Yeah.
Ohio, so
Cold.
yes, because they're stuck
There's
on
gotta be some
juice.
upside.
They gotta give them some upside somehow.
And at 3.5%, what they're guaranteeing, I mean, he was 4. I mean, that's not bad. But now they're going to 3.5, and you gotta have something sexy to sell.
Massive
coming.
ready to come out with some kind of hybrid product.
There's several of them that are looking at it right now. I just don't know how it works, but we're gonna see it.
When it comes out, we will have a class on it.
Two more people need to answer.
So we got 10 minutes
Or you don't
left.
get credit.
That's right. Somebody. We'll give you another.
A few seconds, but yeah, we can keep talking. I'm gonna.
Well, you know,
I'll stay.
we've gone through 20 slides and we got 42 of them. And we got 10 minutes to go through 20. So we're gonna hit the highlights of the IUL.
I think we have been talking about the other products.
Right. I mean, we've hit,
Yeah.
it's just not on
Working
script.
hard.
We got 12 seconds. And the last two individuals who have not responded. Okay. In poll. Share the results. And
Curious, what was the result?
the correct answer is 20%.
Correct. I don't know if it's correct.
So, yeah, it's a good question. But, yeah, 41% of you answered correctly, and so that's way too low. Get out there and educate those women.
Well, there's very few in our industry, other than you 3 in here, which is, I mean, how many
There's a
female
handful.
insurance agents are out there?
Right.
It's a tough business to make, you know? And,
There are more and more, though. There's more and more out there.
yeah, so let's go to page 21, if we could, and go to the IUL
Yep.
overview.
Next
So,
universal
as
life.
we've touched on this IUL quite a bit, it's the newest player in the market. Some of the carriers that first came out with this, I'd be scared to sell what they were
gosh.
showing.
Yeah.
12-14% returns, no caps, no floors. It was something.
Wild Wild West.
Yeah, 18-year surrender charges. It was, I mean, you could illustrate it to look amazing. And that's why a lot of folks went to selling the IULs, and now they're out of the business, because this, if it's not done right, can get really ugly pretty quick.
Yeah, and the industry has put a lot of restrictions and things like that on it to try to prevent
Right.
some of that from happening.
I like an IUL if it's done right and it's the right situation. So it's not anything bad. It's just, you got to make sure you put, I like a lot of these carriers that we offer have a great long-term care riders on this. So if you put the two together and you can have it short pay, you could have it pay if you're 50 years old, you want to be done at 65, you can design it so that it's paid up with a great LTC rider. So there's a lot of flexibility with these plans. It's just, you just don't want to overpromise the returns.
And there are a few contracts that you can actually buy, put on the contract where they actually have some guarantees as far as the death benefit not lapsing as long as you pay the premium. Most of, I think the longest one you can guarantee an index universal life would be about to age 90, which would be sufficient if you're looking for, because if you need anything longer than that, you really shouldn't be buying index universal life, you should buy whole life or GUL. But there are some guarantees that you can have on some of the contracts to give you that little bit of extra, just to make sure that if the person is actually buying the contract for death benefit protection also, that you've put them in the best position for the contract to last as long as they do.
And some of these, there's a little feature, they have a floating 24-month commission. This is when we use the term commission breath around here. When we get a broker to call us and say, hey, what's this pay? If that's their first question, we're like, uh-oh, somebody's going to pay for it. So, but in these plans, a lot of the carriers, let's say the target premium's $10,000, you only pay $5,000 in the first year. When you pay your next $5,000 in year 2, it's fully commissionable.
It's called rolling targets.
Rolling target.
Rolls over to the second year.
Does that make sense to everybody? So you could, that's a lot of folks out there selling it just for that feature alone. They're showing the low target and then getting paid all over again the next year. So when you run into that and you're in competition, you might want to point that out to somebody, because they are definitely showing interest rates that probably they shouldn't be. Anyway, so IULs, we've talked about that quite a bit. We've got 6 minutes, so I'm going to skip to, let's get down to the VU. Dan? We got a VUL opportunity for those securities
registered.
Yep. We can offer those through our products. We've got a few carriers that we have an agreement with, right?
Yeah, we can wholesale VUL with Prudential, Lincoln, John Hancock, AXA, Equitable, a few of those carriers. We've had really great success with VUL with actually the most popular are Prudential, Lincoln, and John Hancock currently.
Yep.
Yours went dead?
Yeah.
Your computer?
Battery.
Oh, the battery's.
Keith, no credit for you, sorry.
Oh, mine's about
So
to go.
VUL, it's out there for those of you security license. Now you should be fine. We'll make sure. Yeah. And
Apparently I'm in the same boat. I was fully charged when I got
I
here.
was too. I don't know why.
I don't
we're just
know.
drawing the life out of you.
Man,
Sucked a
y'all
lot
are
of
just
energy out of
sucking
it.
it right.
So, I mean, you can see what the highlights are on the VUL. As you can tell, the folks that we work with here, for those of you out here that have never met us in person, we've got some knowledge in the room. Like I said, I'm 30 plus years. Dan, how many of you? You about
25.
28.
28 years. And our staff, we've got 25 folks. Melinda's over 20 years that are here to help you. We've got 4 or 5 folks that will quote the business for you, and then 3 or 4 that help process the application. So you don't have to order exams. You don't have to order APSs. We do all that in-house for you. Your job is tough enough to make it. I think it's a higher success rate to get through medical school than to be an insurance agent. It's about a 12 to 15% success rate to get through 3 to 4 years.
Right.
And with medical, so it's a tough business. And we know you've got quite a challenge every day going out there and prospect and what to do with them. So that's what we're here for. So you got to go out and hunt, and we cook and clean it for you. And that's what we've been doing for our agency's 53 years old this year. So we've been doing it for a long time, and we're here to help you and put your clients with the right contracts. So with that being said, we've covered our obligation of the hour and 50 minutes because we took a 10-minute break. So unfortunately, we didn't get through all of the presentation. So like I said, if any questions out there, we got 2 minutes. And like I said, we could send this it's actually a pretty good presentation.
Yeah.
To keep you straight on which product is the right fit. We're happy to send that out. And you've got our 800 number.
We have lots of resources. We have lots of marketing material that we can provide to you that can be customized. We also have lots of information specimens that you can use, concept related, just really good things that you can use with your client, some value add information, as well as any particular information that you could want related to our industry and that could be involved in the life insurance, long-term care, disability, or annuity We've got lots of resources that we can use, can provide to you, presentations and so forth. Just let us know.
Or things
what
you want to
need.
post, September's Life Insurance Awareness Month. So if nothing else on your LinkedIn and everything else, make people aware of that they can talk to you about it and you put them with the right company. You get Select Quote out there. They can buy it on TV, all these different things. There's nothing like getting one-on-one, breaking it down for a client. They're not getting that through a Select Quote or somewhere else like that. So that's the hands-on approach is still the way to go with an intangible product like we sell. So
We can, if you haven't done so yet, we've had a lot of agents taken us up on this opportunity that we can actually set you up for your own personalized URL that will allow your customers to apply for insurance right on your website. And it's really painless for you once it's set up, because basically we give you the marketing face page and it looks like you, it's branded for you, looks great, can be personalized to you. And then you click on that and it actually takes them into where they can actually quote and apply for the insurance and have a policy within less than 10 minutes emailed into their inbox. If you are interested in that and you haven't taken advantage of already getting that URL from us, just call our office and we'll be happy to help you do that.
yeah, there's no cost for that. So you'll have your own, they'll enroll. Like we said, Dan and I had been approved in less than 4 minutes. So your clients can take advantage of that as well if you can market that way. But Mass Mutual is gracious enough to offer this class for no charge. So we appreciate and we try to send them some business. And we're going to try to do a series of these once a month and do 2 hours a month. We got another class coming with.
I submitted a request for next month and the following month for another 2 hours.
Okay.
Yeah.
So we'll try to get you set with all your hours over over a 12-month span. So we hope it was worthwhile and we appreciate you taking time out with us.